In Montreal, we have Louise on the line. Hello there.
Hello.
Hi. What's your question tonight?
I am interested in your advice about Telefonica. Actually, I have held it for a long time, and it has been so weak. I really hold it in Spain.
Right.
But with Europe improving, I'm wondering, I have a lot of shares.
Right. Okay. Thanks, Louise.
So, Louise, probably the telecom sector is not going to be the leader in this market. If you think the economy is slowly improving, you might want to be in more economically sensitive groups. Telefonica is a great company. We do have some telecom exposure, although it's here domestically in TELUS, which we've held for quite a long time. You get a little yield, 2% yield. It's not going to be a huge beneficiary of an improving Europe, but I think it will perform in line with the sector. So I'd be sort of neutral on the stock. If you own it, you can continue to own it. There just might be better places to be if you think that the economy is really recovering, like maybe one of the European financials.
Next up is Don as we get back to lumber once again. Go ahead, Don.
Yeah, thanks, Mark. All of the lumber companies have forests in them, and I'm interested in WEF, and I think you have mentioned them previous. And can you expand on that? Thanks a lot.
Sure. Just the story is quite simple. Supply in the lumber space is somewhat constrained, although there's supply coming from the southern U.S. Supply from Canada is somewhat constrained because of pine beetle. You have companies that have their costs in Canadian dollars and are selling into the U.S., like Western Forest, and so they really benefit when the Canadian dollar falls. So we think in general the housing industry is improving, and so the demand for lumber is rising slowly. And these companies are highly levered, like the airline industry. And as their prices go up, and as their volumes go up, they are big beneficiaries. So Western Forest is one that I think you could buy. There can always be corporate developments that could take place here, and I think that that's something to watch for. But I think that this is a good sector to be invested in right now. We have a pretty significant stake in lumber right now.
Right, and would you say that this one's been a bit of a laggard compared to the the Norboards and some of the other companies, or not really?
The stocks come from $1.35 to $2.25 in the last 6 or 8 weeks. That's not so bad. So I think that this is one certainly that's playing catch up, but it's got some leverage to it.
Next up is Jim. He's in Pickering, Ontario. Hello there.
Good evening, Mark, and hi, David. The utility sector is an interest rate sensitive sector, so it pulled back on those fears of much higher rates, and now that is muted somewhat, and as well with the severe winter and the price of gas gone up, and also wouldn't some of the pipelines be operating at a higher capacity? And does that mean maybe that sector will do better in the coming quarters?
Right.
Thank you.
So, Jim, I don't think you're going to see the same negative influence of interest rates on utilities this year as you did last year. I think we are probably in a new range, somewhere like 2.8% to 3.2% on a 10-year bond in the U.S. But I would say, given the choice, I would prefer to look at pipelines than the straight utilities, and I would prefer within that group to look at the midstream energy companies as opposed to the pure pipelines. So we like Keyera, we like Pembina, we like IPL, we like AltaGas. We own all of those in our dividend growth portfolios. I think you're going to get more dividend growth from those than the pure utilities. So if you can get a 5% yield and 5% or 7% dividend growth, 10 or 12% total return with pretty low risk, I think is attractive.
There you go, Jim. Next up is Norman. He's in Ottawa. Good evening, sir.
Hi, Mark, and hi, Dave. My question is on Bombardier. Dave, what do you think of Bombardier given the latest big media hype about the delay in C-Series, the cuts in the personnel, the over-budgeting, and the over-expenditure for the whole project? Do you think this company has any chance from now to a year or 2 years to recover?
Norman, certainly, anything can happen as things go along, but when you get delays like this in something that has been as anticipated, there's a lot of disappointed investors. So there's a lot of investors who are underwater. And you're going to have to fight your way through all those sellers as they hope to get their money back on the way higher. There's no evidence at this point as to when things may turn. I just think there's better places, better ponds to fish in. I would avoid the stock. We don't currently own it.
Thank you, Norman. Here's an email on Badger Daylighting from Bob. He says he bought it a year ago. What are your thoughts on this company, especially considering tomorrow's split? They're doing a 3-for-1 stock split, so clearly this gentleman has done well. Is this a stock that you've been in? Did you miss this one? Did you?
Well, we certainly missed the first part of it, but we are in it and have been in it for a little bit. This has been just a remarkable performer. And this is the type of company that is available in the market that we're in. These guys have a great growth model, and their return on equity is about 25%. Earnings are growing in the mid-20% range, as are their sales. This is one I think you could continue to buy. It's a $1 billion market cap. It's gone up a lot over the last year, but as long as you follow it with a stop, I think it's one that you could own.
Are they mostly growing organically?
They are. They just keep building these machines and keep putting them out there in the marketplace.
Mm-hmm. All right, so that's Badger Daylighting. Lots of calls and emails and tweets for David as usual, and we put a whole bunch together in the Market Call Minute. Okay, the rapid fire round here for David. Rose in Toronto called in about Teck Resources, speaking of coal.
Hate to be negative, but outside of cyclical rallies, I think that the commodity cycle is not in play at this point. I'd avoid the stock.
Larry in Hayward, Saskatchewan, he called in about Peyto Energy, natural gas going higher again today.
Great low-cost producer, natural gas performing well. We own this stock. It's one that we would continue to buy.
Frank in Calgary on Torque Oil.
Same thing, Torque Oil, very low finding cost, very quick reserve growth. This is one that we own, and it's one that I'd continue to buy.
All right, very good. And that pays a dividend, does it not?
Yes, it does.
Bill in Mississauga on CGI Group.
CGI is fighting sort of the near-term bad news around what happened in the U.S. healthcare portal. This is a good business. They've done a great job of executing over time. I think the stock's probably okay. You're going to have to let the smoke clear in the short run.
But no ownership position?
Don't own it currently.
And Adora in Toronto, she wants to know about your opinion on MetLife.
Okay, so we like the insurance companies. We don't own MetLife currently, but it will benefit from trends in the industry.
But you said you hold AIG, Sun Life, Manulife.
Yes, we do.
Right. Okay, nicely done. We'll come back with the top picks of David Burrows after this break.